Hi guys, I'm AP. In this video, we are going to see the Chapter 9 in the book The Intelligent Investor. The Chapter 9 is investing in the investment funds. The investment funds is nothing but the mutual funds or index funds. Okay, let's get started. The main objective of the chapter is an stock can go to zero, but an index fund or a mutual fund will never go to zero because it's a bunch of stocks. It also add a little bit safety and the diversification of your asset in your portfolio, so that it is the main objective that one should always consider investing in the index fund or a mutual fund. Okay, now let us see the difference between the index fund and a mutual fund. An index fund and a mutual fund works on a similar way. In an index fund and a mutual fund, there will be a fund manager and there will be a team which will analyze and pick a stocks. But in the index fund which will track the indexes like Nifty 50, Bank Nifty, or even Nifty Small Cap or a Mid Cap. It works like people will invest in a index fund company so that the fund manager will rebalance the portfolio according to the indexes like Nifty 50 or a Bank Nifty. The index proportion will work like the in order of the market capitalization, and the fund manager will also allocate the positions according to it. Okay. In the case of mutual fund, the story is different because the fund manager will decide in which stocks he should buy and he should sell which stocks. That will bring an extra team and effort to give a return in his portfolio, so that the expense ratio is so high in the mutual fund. So that the Graham always prefers investing in a index fund so that in the long term we could get a good returns out of it. Okay, but why Graham is opposite to the mutual funds? The main disadvantage is mutual fund is the expense ratio is so high. The expenses is like giving salaries to the analyst and the trader who executes the trade, which is mentioned by the fund manager. And to get the higher returns, to beat the index funds, the fund manager will take a more positions or buy or sell more stocks in his portfolio. It leads to a brokerage and additional taxes in it. So that Graham always advises us to invest in the common stocks and the index fund. The common stocks can give a higher returns, and for safety we can buy a index fund so that the downside risk is protected. Okay. And Graham also says the dollar cost averaging. The dollar cost averaging is applicable not only to the stocks but also to the index funds. If it is at high or low, we should never consider that. We should always buy a small amount or a fixed amount in a regular basis to get a higher returns out of it. Okay. In a worst case scenario, if we are invested in a mutual funds, the company even go to default or a bankrupt. Why I am saying this is it happens in the past. Even though it is regulated by the SEBI or an official body, the fund manager could misuse the funds of the investors by taking a huge positions or by trading in a leverage amount, so that if something goes wrong, the entire amount can also wiped out from the market. This is the risk in the mutual funds. Okay, now we are seeing the journey of the Sensex index from 1980 till now. In around 20-40 years, the India has faced several issues from starting like US crisis, even US loan crisis till the Adani US bank crisis, which is happened in the 2023 beginning. But even though the India faces the major financial crisis, in the long run, it is all about the economical condition and the stability which decides the direction of the market. Why I am saying this is if we invested in a stock yearly, but we never predict that the stock can go to zero or even the competitor can do well, so that the stock doesn't perform for a long run. But in the index, if the stock performance and if the market capitalization increases, then it automatically enters into the index. If we buy the index fund, indirectly we are owning the stocks, so that in the long run our downside safety is zero. Ragam insisted that one should always not have a stocks in his portfolio. Rather than he should consider buying a index fund at least a small proportion, so that his downside risk is completely avoided. Okay, let me conclude this video by saying that first we should identify which type of investor we are. Okay, for now we are a defensive investor, so that we should have a high grade bonds and a common stock portfolio. Additional to the common stock portfolio, we should always consider buying a index fund, so that our downside risk is minimum. Okay, in the next video we are going to see how to select an advisor for our investment purposes. Stay tuned. Thank you.